and welcome to one of our business growth webinar series where we're joined by Finance Fair. So I'll first of all tell you a little bit about Kenora, and Kenora Finance and Business Services is an award-winning accountancy practice and company secretarial practice with a team of almost 80 employees working across Ireland in the areas of compliance, VAT, payroll, bookkeeping, and company secretarial. So we support medium and large e- SMEs, and as well as that, we support a lot of startups in their early stage. So today we're joined by Gary from Finance Fair, and Finance Fair is redefining how ambitious companies secure funding and scale strategically. So I've no doubt that you'll enjoy the content of today's session. I'm the head of sales at Kenora, and I'm joined by Kira McFeely, who's the head of cloud services. So Kira heads up the team in cloud services that are responsible for supporting businesses with their outsourced CFO, bookkeeping, and payroll needs. Then Gary is a highly accomplished business leader with a proven track record in business expansion, strategy development, and revenue generation. So the session today will cover the importance of strategic financial planning for a scaling business, the different types of funding options available, that's equity, debt, grants, revenue-based financing, and how to determine the best funding structure for your business, as well as many other things. It is important to note that today's webinar is for general information purposes only, and that for specific advice, we'd ask you to reach out to an expert, either ourselves in Kenora if it suits you, or to Gary and the team at Finance Fair, depending on what your query is. Now, we do have a Q&A feature within the webinar, and I would encourage you all to ask your questions, and I'll pose your questions to Gary and Kira on your behalf. So do share any questions that you have there. So I'll be handing over to you now shortly, Gary. So if you wanted to get ready with your slides. And for now, I'm just going to launch a poll for all of our attendees to submit their responses to. So you'll see some questions on the screen there for you now. So if you could all just submit your answers, that would be great. We can see your screen fine there now, Gary. Thank you.
That's great. Thank you.
So there's two questions there for our attendees to answer in the poll. I'll leave that up for another couple of minutes. And I'll hand over to you now, Gary.
Great. Thanks, Christina. Really appreciate the introduction there. And I definitely jumped in way too early on this, but I was really impressed by the attendees here this morning. So it's great to see you, and thanks for the opportunity to chat to everyone. As Christina said, yeah, I'm the head of business growth for Finance Fair. What does that mean? Essentially, I work with business owners and their teams to craft funding solutions that are specifically a catalyst for scale. So that's what I wanted to talk about here today, really. And I wanted to start by kind of painting a picture of the market. So the typical funding path that a company might go on from the original idea at the kitchen table right up to that big exit, whenever that happens. And if only it was as simple as a straight line, that would be great. But the journey is not like that, and funding along the way is critical. So what I wanted to talk today about is like the types of funding that become available, the types of funding available at the market, and when, sort of give some advice around, look, when is the right time to go or not. There's no silver bullet to this, that is for sure, but there are ways in which you can plan and make really key strategic decisions at the right time that guarantee scale. But we're really advocates at Finance Fair for scaling in a sustainable way, as opposed to scaling too quickly or scaling in the wrong direction and all the kind of problems that come with that. So what you see on the screen here is just an illustration of what you might see a typical funding journey going. At the very early stages in Ireland, the ecosystem for startups is excellent. You've got government programs, you've got multitude of finance options, small business loans, grants, supports through the Leo Enterprise Ireland. You've got a whole network of angel investors. There are hubs, there are communities you can go to mix with like-minded people. The ecosystem in Ireland is excellent. But as we would see it, the point at which a company is poised for scale is the point at which all of that actually disappears. There is really no ecosystem in Ireland for companies poised for scale. So typically, a company that reaches about 300,000 in revenue, underway. They've proven market fit. They've built a small team. They have opportunities abound in front of them, and they're poised to make some transformational decisions around how they're going to scale and where. Are they going to scale in Ireland, or are they going to scale abroad? But that whole ecosystem of support pretty much evaporates at that particular stage. So at this stage where you're poised for growth, expansion, or scale, really there are a couple of options. So you have the traditional finance options, the banks, say, for example. But if you're in a certain industry where you don't have any assets, so maybe you're in a SaaS or e-commerce sector, you don't have any assets, the banking model of funding is asset backed. So it doesn't actually suit your model and you don't suit theirs. And that's okay. The other options that are typically available then would be venture debt or private equity. And that also comes with some challenges and opportunities, but that's it. So not only do you get to the point at which you're going to actually take off for your business, actually the opportunities for funding narrow considerably. And we would coin this term scaling edge, because this is when really critical decisions happen. If the bank funding or traditional funding model is not available, where do you go? If you think that venture or private equity is the only solution, you're then having to give up part of your business in order to access the funding. And while that is important, I suppose we would always say, well, actually, do you really need that? Do you really need to actually give away part of your business now? Or can you bootstrap further, or can you source other forms of non-dilutive funding that allow you to retain ownership in the business, increase the revenue, grow the valuation, and perhaps then go down the route of private equity investment, whereby your company is valued higher and you're getting more for less in terms of giving away the business. So the trade-off at this particular point is, when do you do this, and how do you actually get from A to B? Because you know the opportunities in front of you. So how do you do it? So if I move on, I guess to bridge that growth funding gap, what we know, okay, and this is not to throw shade, but it's just a fact, and it's been dealt with every day as business owners try to grow their businesses. The traditional funding model, if it is applicable, is often very slow. It's very selective in terms of the sectors that are a good fit, and it is asset focused. So if you're in a business, as I said earlier, in the IT sector, you're a SaaS business, subscription model, you really have no assets, you have an IP. That doesn't fit. So that's a problem. Even if you are a fit, the decision timing in a lot of cases is very long and drawn out. And in the current market where everything is moving faster, I guess you need to take opportunities very quickly as they come your way. So that slow decision time is a barrier to growth. The other piece then around equity raising, if you decide to go down that route, is obviously how it works. So the covenants, the warrants, the kind of the terms and conditions that come with that. We had a guy who articulately said when he got an equity investor involved is that he swapped one set of challenges for another, because he now had people in the business who were good people who were adding value, but there was an added pressure on growing the business because they had milestones to hit and very high levels of payback. So that's okay as well, but at the same time, that is an added pressure when you're scaling, and you have to trade that off. Also, in actually securing investments, it's really lengthy. On average, it takes between 6 and 12 months to go through that pitching process, which is a very long period of time. And you're usually taking the most senior and influential members of your team away from the running of the business, which is what they're there to do. And that can have an impact as well. So that's really worth considering if that's an option for you and you're considering that. And then obviously the right funding at the right stage, not one size fits all. So for example, if you get traditional lending, be it in a loan or an investment loan or an investment from one of your investors, you need $1 million. You've quantified that scaling gap to be, if I only had $1 million, I get from here and I grow my business from a 300K business to a 3 million, or $1 million to 5 million. If only I had that $1 million, I would spend it. So what you will get when you go to a traditional funder or an equity investor, you'll get your $1 million. you'll get it day one, but you don't need it day one. And you definitely don't need to be
Mm.
paying the cost of funds from day one. Okay, so the right funding at the right stage means that aligned to your strategic growth should be a well capitalized funding plan that gets you there in stage. So the control of the cost of funds remains with you, and you don't have the added pressure of managing the cost of finance in the business as you're focused on scaling. So having that ability to draw down in phased or staged milestones as you hit it is really, really important. And when I mentioned earlier on about scaling sustainably and scaling smartly, and I'll come to it a little bit later on in terms of how Finance Fair structure it, but also just generally, because one of the other pieces of advice I'll give is that relying on one source of funding is also not a good way to scale. That you should have a diversified pool of capital, that mitigates any risks that might come into the market, but also gives you sources of funding that is a right fit. So our solution and value at Finance Fair, really, we do deliver fit for purpose funding to bridge that scaling funding gap and really put in place funding that enables and is a catalyst for growth. We're fintech. There's a team of 40 of us, but so our IP is our people in the business and the relationships we build, but we optimize the best technology that we've developed and also in the market to make decisioning really quickly. So we can get a decision to you in 24, 48 hours once we get the financial information. And the onboarding and ongoing management of it is very tech focused. So we cut out an awful lot of the admin that's typically required. We use the best technology available to do all the financial analysis, due diligence, AML, etc. And we're non-dilutive. So our funding will enable scale. You'll be able to get a source of capital to invest in strategic, in strategy, should I say, that will get you there. But we won't take any of the business. So when you get to a point, for example, as I said earlier, at about 300K turnover, you're a good fit for us. And as you grow your business up to about 10 million, we can give funding from 50,000 up to 2.5 million during that period of time to help you get there. But we won't take any of the business. So at the time of which you achieve that milestone of 10 million plus, you can still retain as much ownership of the business as you need. And perhaps then you go and you get your debt or your venture debt or your equity to go abroad. And we're future focused, right? So typical funding models have a kind of a rear view approach to funding. So they look at what you've done, your credit record, how much money did you make last year? Can you pay us back this year? While we do actually look at that, we're really more future focused. So we'll pay way more attention to cash flow forecasting and the future pipelines that you're building. Because that's what we're essentially funding is the growth, because that's what we're specialized in. So that's a unique approach that we take, and often, we might tailor our funding that again, once you achieve certain milestones in your forecasted revenue growth, you unlock further funding, and as your revenue grows, your funding level on our platform also grows. So it's a great model for that by looking forward all the time. What we usually see companies talking to us about at that scaling stage are kind of key levers for strategic investment. So market expansion is what it is. It can be a local or an international market expansion. But so whether you're going abroad into the UK or into Europe or into the US, you have to invest in that. So typically you're looking at things like market research. There's a huge amount of time and resources required to actually understand the market, understand the competition, the regulatory landscape, to understand the opportunity, to size the market, to see actually is there an opportunity over there. When you do it, do you hire a team? And what is the cost associated with moving into a market and hiring in that market? If your strategy is through customer acquisition, so you're going to go, you've built your product, you've built your team, you now see opportunity to expand, and what you really need to do is let more people know about the problem you solve and your solution. Customer acquisition is a key strategy to drive and accelerate your pipeline growth. Again, you need to invest in marketing, which is a huge expense to get that brand out there. You also need to hire perhaps a team to manage all the leads that come in. And so all of this funding needs to be tailored to actually be able to build on that. Then obviously at the moment, AI is the hottest topic, and most companies are in a period of digital or operational transformation as they find efficiencies in how they actually do business. There is investment in that. So you might have to overhaul legacy systems. You might have to invest in bringing in new systems, in putting in cloud, whatever that might look like in your business. Manufacturing, regardless of every sector is going through an evolution at the moment, and AI is there in the background, waiting for it. And finally, then you might decide that you're going to scale through acquisition. So you've perhaps maxed out the market that your particular company can do, but you're going to bolt on value add companies and you're going to acquire them. You need significant capital to be able to go on that acquisition strategy. So I might just pause there. I don't know if you have any questions at this particular point.
Yeah, there's I'm actually thinking this is great information, Gary, and it's a lot of information, I suppose. So there's a few points I suppose I wanted to kind of just jump back to. We had a client actually recently who went through that sort of VC funding stage. I don't think they realized just how difficult it was, the impact it would have in their business. So they get to that, as you call it, that scaling age, and it nearly feels like businesses have one of two decisions. They either go with a really hard decision, which has such a huge business impact, they do nothing and they miss out on their opportunity. So it's great to see that there is an alternative out there for people that, they maybe don't want to dilute their ownership. I'm sure that that's a really difficult decision when you get to that point. Do you take on funding and take on and dilute your ownership out and maybe dilute a bit of control? That's a really difficult decision for business owners to make. So it's great to see there's another option. Another thing that really jumped out to me there, Gary, is the length of time there. 6 to 12 months, dropping that down to decision within 24 hours has such a huge impact. There's businesses are faced with opportunities and they can't take them if they have to wait 6 to 12 months to get funding. So that seems like a great alternative. I don't know if you could talk a wee bit about that kind of difficult decision around what's the right move there, especially with that ownership part. I think that's a really, really tough change for a business.
Yeah, like it is, and like the hard yards have been done at the time where if you survive that early growth stage, you've bootstrapped. There's an awful lot of hours and blood, sweat, and tears, shall we say? In terms of building a business to get there. Now all of a sudden, the option available to you for funding requires you to give a portion of that away. At some point, it is probably smart to entertain the idea of taking on equity, because when we think about the growth strategies that are there, market expansion, for example, digital or operational transformation, perhaps you're acquiring new companies. They may not all be in the same sector that you're in. So it might be advantageous at a point to go down the equity route, to bring someone into the company that brings expertise that you don't have. And there will always be a point in which you have to have that honest discussion with yourself, I guess, as a business owner, as to, I know what I don't know, and we've gone as far as I can take it without bringing in the expertise. And anybody who has successfully scaled talk about who they brought in and when as being key to achieving the scale. And I think the only piece I'd say is that, if we're operating in an Irish market where when you get to that point, the only two options are give it away, what you end up having to do potentially is give away a portion of your business way too early. So you haven't given it the time, and then you haven't burst through that scaling edge period to actually get a higher valuation, so that when you do bring someone on, you're giving it away. So, and then, that time piece, like, it's huge, because there's, I know definitely in the UK, for example, Q1 of every year is when most investors tend to have their pitches and get people out, and that's the start of it. So you've got to do rounds of this kind of pitching and people might be interested or not. And then you have to go into due diligence stages. And so
Mm.
all of that requires huge resources. Now, if you're a lean team, that
Yeah.
takes away from the potential to grow at that critical point as well. So there's all of the things to be considered, for sure.
Mm.
Yeah.
Yeah, the digital transformation part is definitely, as you say, AI is so relevant at the minute. And we do at Knorr, we do what we call digitalization projects where we would like support clients in digitalizing their financial function. Because there is so much opportunity out there. There's a lot of software options out there. And it's almost finding the right fit there too. As you say, it's bringing in the expert that understands, the needs that they have and matching them up with the right solutions. So yeah, it's an interesting time, but it's a very difficult one, I suppose, to know what's the right move when.
Yeah, yeah, like the world generally in our own, even our own personal lives, it's moving so fast.
Mm.
Technology is operating at speed, and AI is just driving this. So
Mm.
for businesses, and particularly in funding, opportunities are presenting themselves faster.
Mm. Mm.
And the ability to adapt and take advantage of those at speed. If we think about the Irish funding market, it's just there's blockers everywhere you look, like
Mm.
that scaling ecosystem, definitely Ireland Inc., I would say, need to do more in this space, that there is more funding available through various channels that are a catalyst for scaling companies. When you think about the companies we're talking about here are employing from one person up to
Mm.
100, they account for about 1.4 million of our workforce at the moment, which is huge, for the
Huge. Yeah.
business. And obviously, we're quite an innovative, well-educated society.
Mm.
We've got loads of expertise. One of the benefits of having these large multinational tech companies in Ireland, and they've been here for a few decades now at this stage, is they're producing really sharp entrepreneurs, developing
Mhm.
cutting edge kind of solutions that are impacting on the world stage. So we absolutely need to create that ecosystem, similar to what we do for startups, that allows companies tap into international markets. So it's there.
Yeah.
And I don't want to do a disservice to people who are doing really, really good work in this space, across the country, but to really leverage the potential of Irish companies
Mhm.
scaling, would be fantastic. Just would be fantastic to have this
Mhm.
ecosystem, because a lot of we go back just to your question around the venture piece, and the equity piece. There's an awful lot of international investors looking at Ireland and investing. There's an awful lot,
Mhm.
so we do need to make sure that it's Irish people who have that success story, who have invested in
Mm.
business, who want to give back, who want to actually invest in companies in similar sectors and give back, capital, but
Yeah.
also give back expertise to help them scale, and
Yeah.
pay it forward that way. It would be just great to see a little bit more of a dynamic in that space, I would think.
Yeah. Yeah. Okay.
So we keep going, yeah, if that's okay,
Mhm.
because what I wanted to talk about next is just some of the headwinds that companies are facing. So you've got your growth strategies on the left, but then you've got these macro level market challenges that you just simply have to find a way to get around. So going back to my point there around the employment, I think actually we're almost at full employment. There's about
Mhm.
2.8 million people employed in this country at the moment, which means that the market and the cost of hiring is
That's
really,
huge.
really expensive.
Yeah.
Um,
Yeah.
Mhm.
it's just, and it's of course every single sector. The cost of hiring is significantly increased, driven by the cost of living. So people are demanding more, because they need to outrun inflation and the cost of living, etc. And particularly if your company is based in urban centres, think about Dublin, and particularly the cost of renting, the cost of buying a home is driving the cost of actually having to hire people. So um, there are alternatives. So for example, we would partner and work with and see growing demand for fractional C-suite. Okay, so these
Mm.
and also outsourcing other aspects of your business. For example, like what you guys do, for example, where you specialize in outsourced services, where you don't need a person in-house to do it. And particularly at that strategic level, there are companies out there, like I'll name drop them because they're good friends of ours, the Agile Executive, CFO Center, for example, all provide experienced C-suite members on a fractional basis. So you can reduce the cost of what you need, but you can get in that expertise to put manners and rigor around the strategic direction of your business, financial expertise, sales and management, all of the things you might need. So I'll do a shout out to those guys because I think they do great work, and we work very closely with them as we do with you guys, in terms of adding value in a very digital and dynamic and fast way, actually.
Yeah, absolutely. We have a couple of clients that are working with those as well, Gary. And as you say, it's just such a cost-saving measure at keeping your business sort of focused on growing, but bringing in the right level of expertise at the right time, and not following that traditional business model, because there's nothing traditional about the landscape that we're operating in at the moment. As you say, the market challenges make it very, very tough for businesses. So yeah, leveraging on outsourcing now more than ever for particularly early stage scaling businesses, rather than carrying all of those fixed costs, just is such a better option.
Yeah, it's just, and again, I'll go back to kind of smart and sustainable scaling here. There's ways in which you can be very clever of achieving the same results, if not better, by making these types of decisions. And as you said, not following that traditional path of building a team, full-time employees. You're kind of a hybrid model of doing that. And look, I mean, we're all on Zoom, we're all on Teams. These things can be done so agile these days. You don't really need that. What you definitely might need is the expertise that they'll bring, and that experience they'll bring to a business if you're at that scaling edge, or as you move from that growth, expand, scale stage. The different complexities that are needed at each of those stages. That expertise in the business can really help guide along the way at that stage. So some of the other challenges, look, we've talked a good bit, I think, already around capital investments, and what are the different approaches that you need. And I might come to that again. The market research piece is really important, because one of the greatest things about AI at the moment is you have access to all the data, so it's never been easier to actually understand and get data. But really, if you're looking to scale into a new market, either locally or internationally, it's having that ability to quantify the market to make sure that any investment that you take on will actually have a return on investment at some point in the future. So applying the time and the capital to get that due diligence correct, particularly if you're moving abroad, let's call it that. If you're thinking about scaling into the UK as part of your strategy because you've maxed out potential in Ireland, like, that piece is huge, and having access to the right people and the right data in order to do it. And then obviously it's the debt mix, which when you're looking at funding and capitalizing for scale, like you have to be capitalized for two things. You have to be capitalized for growth, but you also have to be capitalized to prevent against risks. So if we think about the macro level impacts on the business, and how they, like we look at Brexit, we look at the war in Ukraine, and how something that happened way outside of our control suddenly impacted the cost of doing business. We look at 2025 and ahead with the impending potential of a trade war between the US, China, Canada, Europe, and the impact on the cost of doing business that it will have. You need to have capital in the business that prevents and mitigates that as well, and so it's really smart that while you're investing in growth, you don't outrun that and actually take on too much debt, invest it all in growth, and then all of a sudden things happen and you haven't got that kind of cash runway developed based on recurring revenue in the business to protect yourself and make sure the lights stay on, to outrun it or make sure it's there. So there's that kind of smart way of doing it. And if I go right back again to the point I made around some of the funding options in the market, the sort of theme of this morning's webinar, if you get that million day one, there isn't any person or business that wouldn't have it spent within 6 months. And if they look back on it, they might say, God, do they really need the fancy office and the nice things, you know? So maintaining a discipline and really lean approach during a period of scale is it's a good way to do this, you know, because and only taking on the money and strategically deploying it when you need it will get you where you need to go while keeping things lean, you know. So they're the challenges, and I guess some of the ways in which you can outrun them. So we've talked a good bit already actually about this, which is no harm, but like the funding challenge is obviously access to funding. So those options diminishing, you know, managing cash flow. So like you have to cover your costs. Obviously, you have to keep the lights on, and you have to pay the people that you're employing, and then you have to, you know, deliver the solution, the product, whatever you're doing. That has to happen. Managing cash flow is the tightest time. So if we think about the sales cycle of certain businesses that we spend a lot of time in, you know, it's where maybe you've the work done, you've invoiced, and you're waiting to be paid. So it takes you 2 months to get the work done. You've invoiced, it's going to take you 2 months to get paid. Meanwhile, during that period of time, you're having to cover all the costs and fund other contracts. If you're an export business, you might need to be importing components from abroad. You might need to pay 50% up front to your supplier in China, and then you're waiting 6 to 12 weeks for your goods that are sailing across the sea, and then they land, and then you have to make them. So it's hugely capital intensive to grow a business in certain sectors. And, you know, that just prevents growth, because what you're doing is you're constantly fighting and you're banking all of your customers. Essentially, you're becoming their bank because you've given these credit terms, or they've given you these credit terms that trap liquidity in your sales cycle, and, you know, can become a barrier to growth. And then it doesn't take an awful lot in the market for costs to rise, for your business model to feel that pressure instantly, and then you're actually looking for funding solutions. You're under pressure, you know, that kind of model, and we would see that, you know, we would definitely see that happening. So cash flow management is key, and it goes without saying, obviously, having someone in the business, having good manners, having kind of good processes and systems and everything in place that keep well on top of that. So somebody's late paying, you know, or there's challenges in the market, or something happens at the sea and your goods are delayed, that you're on top of that and you're able to deal with it. We've covered dilution quite a bit, I suppose. Really, giving away your business and when is a key decision, and then obviously that the diversified funding. We would advocate, obviously, and we work alongside a lot of the banks. We work alongside a lot of the equity investors, the early seed investors, the capital houses, and the best businesses we work with, the ones you get impressed by, those are the ones who look at what it is they need the money for and take the time to get the right funding mechanism for it, you know, so that it is a fit and it's tailored to actually what they need, and that you're capitalized across the board, as opposed to relying on one single source, either your existing investors, either yourself as a director, or as a single source of funding. So look, I think I've covered off some of the ways in which you can plan the building financial resilience here. You'd be very surprised about the amount of companies who actually don't have the right financial pack in place, you know, who don't have a handle on the numbers, you know, who don't.
We get that all the time, Gary. You know, you wouldn't believe
Really,
the amount of clients that it's actually been quite shocking to see how many clients that come to us and they don't even have a management pack at all. You know, their financials are as a P&L. Just a P&L.
Yeah.
And like anybody that works in finances know that is just one side of a bigger story, you know. So we find that all the time, that where they're coming in and we almost say, well, this is the standard that we would expect to deliver, that we think is going to be a lot more value, and it does bring a lot of value. We talk with clients all the time as well about knowing those numbers. It's so crucial. Like, you know, we have a client actually that it jumps to mind, where their business is just based on opportunity, and they have to be able to step into that opportunity when it comes. And the only way they can do that is by having a live system that they can pull a management accounts pack from. So we support them in getting, you know, keeping that up to date so that they can take that opportunity when it comes. You know, the amount of businesses that come to us, and whenever they're looking for funding, they pull last year's financial statements. And, that could be so historic, it could be completely irrelevant to today. So that's just knowing your numbers and having that system that's so secure is amazing. We actually had another client come on recently, and this one which is real was a real learning for them. Whenever they came to us, their credit terms for they were working with really big established companies, and the credit terms that they had been given were 3 to 6 months. So they wouldn't receive payment on their invoices for 3 to 6 months, but they were actually paying their employees weekly. So, something so simple as aligning that a little better has made such an impact on their cash flow. And, having that live and financial information allowed them to see that and to make that better decision. And it's all about making better decisions, You can't make better decisions without the right information.
Yeah. Oh, totally. Yeah. Yeah. The CRO in Finance Fair says, in God we trust, everyone else bring me the data,
That's a great line.
You can't make informed decisions if you don't have the information. And I think, so we would see it certainly from companies, obviously looking for funding solutions across the board. And when you're talking to them, particularly like where we're standing in February, most year-end financials that have been filed at this stage are December 2023. So you have a full year trading that where you need to produce management accounts in order to kind of fill that gap for a funder, for an investor, for whoever is going to look at your business to fund it. So and like the easy thing here is there are so many cloud-based accounting software packages available at the moment. It is really important kind of basic thing to get into your business. And then the production of management accounts and figures, if that expertise is in the business, is obviously to reach out to companies like Knorr who can provide that service for you, because staying on top of it is the most crucial part of running the business, and then obviously to understand what metrics you're tracking. So your burn rate, your cash runway, your customer acquisition cost, there's a lot of KPIs in a business that you should be tracking, that you can check in on each week and understand how are we getting on, how are we doing this week. And they are easily done now with very much automated services that are out there or outsourcing it,
Yeah, a really great monthly pack won't just have finances. It'll have those KPIs, like you say. There's so many metrics there that you just need to keep an eye on to see that you're tracking in the right way. Very easy to lose track.
Yeah, exactly. And like you're driving forward, and everybody wants success, and you're really moving forward, and then you don't mind the house, and the immersion's left on, and all of a sudden then you can't afford to go on holiday. So it's kind of you need to have that due diligence in, and it kind of goes back to the getting the expertise around you, that fractional C-suite, or having your accountants and firms like Knorr, for example, to have that rigor and manners put on the business, that should you be available. And also actually just at another level, and I go to the final point here, which is always be investable. Like, what you need to always be ready for this, because I have a great advocate for a book called The 7 Habits of Highly Effective People by Stephen Covey. It's like a Bible, isn't it, in the business world? But he has one of the 7 habits is to begin with the end in mind, and almost every single person that sees the opportunity at the other end of that scaling edge, is beginning with the end in mind. So you should always think about expanding abroad, even if you're only 4 of you in the business. And you should be building a sustainable and lean business internally that's constantly ready for scale. And that means that if you're an owner and you're the engineer, or you're the CTO, you're the tech guy, that's what if you're not good with numbers, bring that person in straight away, so that, and get them to feed you the information so that you're always ready to talk at a financial level about the performance of the business. So you get to your product, the problem you solve, your solution, and then the numbers. That's it. That's your 4-slide pitch deck. What you need to talk to anybody about. Isn't that it?
Yeah. And Gary, I know you'll be moving on to solutions shortly, but we have had a question in from Paul asking, what about tech startups that are pre-revenue? Do you support them also?
We don't. So our model, so at Finance Fair, we're very much focused on growth funding for scaling companies. So you will have had to come through the startup phase for it, you know. So we're not, we work alongside that early startup funders and investors, but we come on board at that where that gap in the market currently is.
Yeah, so like post potential Leo or Enterprise Ireland or Scale Ireland support, you know, and then when they're at that point of have an established business model, really, Gary, is when you step in.
Yeah.
Yeah, yeah.
Absolutely. But what I will come to, however, so what I would suggest is that, like, as a tech company, you would be a fit for our model at some point in the future. So there might be an inflection point in the future whereby you are at the point of scale and you need to talk to us. And what I will come to are some of the ways in which Finance Fair fund through this gap, you know, that mitigate all of the things that I've addressed here as being challenges in the market. Which is really good information to know. Because at the core of what we do, why I do these talks and webinars and everything, is just to provide at the very high level, you know, solutions, ideas, and other options that are available in the market. And then obviously in the hope that you will talk to us and come on board with us when the time is right. So I'll do that. I think if that's okay. Like, so we're in business 10 years this year. We've a team of 40 now and growing, which is just really, really enjoyable to be part of that environment. And we've provided since inception about over 2 billion in funding to scaling SMEs in Ireland and the UK, but primarily in Ireland. We've completed over 10,000 successful transactions, and we're funding working capital receivables across a diversified sectors. So, you know, we look at SaaS and e-commerce as being largely underserved in the market because of all the things I've alluded to earlier on. But then across all other sectors where you're generating revenue, but you're waiting to be paid, or through future recurring revenue through contracts or non-contracted revenue, you know, there's liquidity trapped in all of that. And all of our solutions unlock it to give you a source of capital from within your own customer base to scale, and to scale smartly. So typically, you know, SMEs with turnover from 500,000 to 10 million, who are forecasted to grow or have a track record of growing about 20% year on year. You know, in truth, our line of credit solution that we launched there about 18 months ago will actually, you can come on board at 300k turnover and get a funding line of 50,000 to get you going. And we work right the way up to 2.5 million. So we're a scaling company ourselves, you could say, and so we understand from every fabric of our company what's involved in scaling and the kind of growing a presence in the market. So I've summarized our solutions here, and I have some other slides. You know, going into more detail, I can share them afterwards if anyone's interested in this. And pursuing it further, it gives you everything you need to know here. So we've 3 solutions, but what I want to really emphasize here is how we apply our minds when we're dealing with a company. You know, we're dealing with working capital for growth, essentially. You know, and working capital ebbs and flows. So no 2 businesses are the same. No 2 contracts are the same. So what we provide is flexible funding that adapts and is aligned to the revenue models of companies, okay? And more importantly, aligned to the growth trajectory of that business. But we do obviously have that kind of folded into 3 distinct products. So revenue-based finance is really good fit for SaaS subscription model where your revenue is the future. So you know you're good for it because you've signed contracts for 12, 24, 36 months. You have predictable recurring revenue coming in every single month. Revenue-based finance allows you to access that future capital today to reinvest in the growth of your business. So you can use the capital that you unlock from contract A to fund and establish and get going on contract B, and use contract B on contract C, and on and on. So if you're scaling through customer acquisition and you're adding customers at speed, this is a fantastic solution, particularly in the tech sector, you know, or the e-commerce sector, to actually grow your customer book, grow your revenue. And as I say, there's no dilution. So it's very effective in that way, looking at the future. We obviously have a form of invoicing because we're receivables funder at the end of the day. But it's a more modern tech-enabled solution to sort of traditional invoice discounting, which will take your entire debtor book, kind of have an operational piece, will deliver cash flow to your business for sure, and is a good option. But our option is very much light touch, so you can access up to 90% of your invoices the very next day after you raise them to your customers. So you send them to your customers, upload them on our platform, and you get 90% of the value the next day. It's a very flexible model insofar as if you are a seasonal business or you do actually reach a period where you are cash rich, you don't pay for that facility, or you only pay for it when you use it. So you could have a selective invoice facility on our platform. You use it month 1, 2, and 3. You don't use it for month 4 and 5. You only pay for it as you use it. So it's a very effective, simple, easy to use way of unlocking capital in the business to kind of reinvest in the company as a cash flow. And then we have line of credit, which is a fully automated working capital solution. The funding limits start at 20% of your annual turnover up to a limit of 2.5 million. And you can draw it down whenever you need it. And you can have multiple revenue streams in your business. So if your business has revenue from invoicing, so work done, waiting to be paid, your business could have contracted revenue, so you could have revenue into the future, and you might have an online sales. The line of credit wraps all of those business models into one and gives you a capital line on our platform that allows you to access funding. All of these suit specific businesses, but mostly it's sector agnostic. Particularly so revenue-based finance exploded for us last year because of that gap in the market. And when we're talking to e-commerce businesses and SaaS companies, there's very limited options in the market, but we have an option and we have a solution. The real benefit to all of our funding lines here is you come onto our platform and you might need $1 million. Okay. So we'll say to you that, okay, you're good for $1 million, but you actually don't need $1 million today. What you need is 200K today because you want to invest in your marketing strategy. Now, all of a sudden it's month 5 and the leads are pouring in. You need to hire a team so you can draw down additional funds at that stage. Then you're going to enhance your product, or then you're going to move into the UK. So the turnover or the drawdowns can be phased, aligned to your growth. So when you're dealing with us, we'll actually take your cash flow forecast in Excel and we'll model in the solution into your forecast. And so you'll see what the cost of funds will be and how to manage that aligned to your growth. So from the outset, you're able to scale and manage the cost of scale on your own terms, which has made this solution like really, really popular for companies that we deal with. The details are here, but what I wanted to emphasize on this particular slide was the process of coming on board with Finance Fair. So as I mentioned earlier, we're a tech company where we use the best tech available in the market to optimize the financial analysis, underwriting, and due diligence, which means we can give decisions, within 24 hours. We can get funding within 24 hours. So typically what will happen is we'll get a financial pack. Okay, it'll be your last financial accounts, your management accounts, provided by Kenor, and then you will have your cash flow forecasts. And if your receivables in the business are from invoicing or contracts, we'll look for a debtor ledger in that case. It goes without saying your tax is up to date. We'll check that on, but we'll get the financial pack. We'll have an indicative offer back to you within 24 hours that'll say, this is how much we could give you now. This is how much you might get in the future. This is the cost. These are the next steps. We use open banking. So you connect your accounting and your banking software to our platform in a read-only fashion, and we can instantly underwrite based on the financial analysis. So that saves any due diligence. You don't have to download statements from your bank, upload them to an email, which is significantly less safer, and email them randomly to these guys that you found and met, that you saw on a webinar. So it's really safe, really seamless way of free sharing information. We'll then come back with the formalized facility and a link to register on the platform. You register on the platform, you upload your customers, and then as you need funding against those customers, you simply upload the invoice, or else you submit a drawdown request if you're a recurring revenue model. And that's it. We don't contact your customers. We operate on 100% discretion, and it's a really seamless way of doing it. Typically, the lead-in time is between sort of 4 to 6 weeks for facilities up to $1 million, and for facilities higher than that, it might go out to maybe 8 weeks. But you will know very quickly that you have funding available on our platform. And that's really important for us. Like, the whole business was built on that, of fast decisioning. So whatever about giving it fast, what that also gives is certainty, so you can actually then take advantage and plan and strategize, knowing the funding is available and that you have that locked in on Finance Fair's platform. So
really quick turnaround, Gary, as well, isn't it? So it really makes such a difference to businesses that just need access to that funding, have an opportunity in front of them right then there, so it's amazing, the quick turnaround there too.
Yeah. And look at the business was born out of a gap in the market. But if you think back to 2014, 2015, post crash, the market was locked. There was nothing, and it was taking forever. Meanwhile, you had companies still trying to grow, and all of this happening. So the entire business model has been built around being able to give certainty at speed. Like, the funding is a given. We've funding available, and we want to deploy it. But in that interaction and in that relationship that we have with our customers, it's certainty, it's confidence, it's compelling and flexible terms, unrestricted. They're the things that we live by, because that is our unique selling point. And it's why, as I have a number of companies that we've supported along the way who've kindly given us permission to promote that we partner with them. You might have seen a recent announcement there with Joe Media, where we provided $2 million in growth funding to help them scale in the UK. I would point your attention to a case study we have detailed on our website, top left there, Cameramatics, a SaaS company scaling into the UK, and who delayed a significant equity round by taking funding from us, which then subsequently grew their revenue and increased their valuation, so that by the time they did actually go, they had done all of those things. But they talk about it better than we can in terms of what it meant for them at the time, because they had reached that point. But all of those companies are hugely successful across all of the sectors that they're involved in. Fundamentally, at the center of it all, they're driving revenue in 3 or 4 key ways. And we have the solutions that can get in behind them and really unlock that liquidity that's in there, convert it into a source of capital, and allow them to fund their own growth from within their own customer book and their own success. The more they grow, the more funding. If you think about it, we give 20% of your annual revenue. If you're growing your revenue, you're getting 20% of growing revenue. So you come on at 200,000 onto our platform, and as you grow your revenue, you're dialing up that 200 grand, quickly becomes 5, becomes 7, and you're not diluting as you grow. So you're the more successful you are, the more funding is available to us, and as you build up that track record on our platform, and that becomes really easy. And if you're a customer with us, you need more funding. That decision, because we have all the information, we've a relationship developed with you, and that funding approval comes in 24 hours. So that's the easy bit from us anyway. So sort of that's, look, I am conscious of time, and maybe if there's any questions and so on, it'd be great to open that up and open the chat about what I've covered here. My details are here. I am on LinkedIn, very active. I'm warning you up front. You will see me every week on LinkedIn talking about scaling, the challenges of scaling. I'm very passionate about this, and really enjoy working with companies in this space. So be warned if you follow me on LinkedIn, but please do, and if you want a confidential conversation, my mobile number is there, and I'm available to have any chat, regardless of what stage you are. Conversation costs nothing.
Gary, that was a great session going over everything. I have one question here from Kate just asking what are the standard rates? It might be quite specific, so I'm going to share the Finance Fair email address here. But
Yeah.
yeah, opening that up to you, it could be that it's dependent on each business.
Yeah, each business is very different for us, and if you know, if I could leave with anything, like, we tailor solutions to companies, so each company's unique model is very, very different. So, you know, it's important to think about the difference that we offer in terms of that revolving credit line, where you get $1 million, but you don't get it day one, and you're deploying it. Our funding models and our pricing is based on that fund deployment throughout the year. So the benefit to a customer is that they are controlling the cost of funds all of the time. There's never a kind of a fixed overhead that you have to hit regardless, and you're paying for it even in months that you don't need it. So I couldn't in good faith say we charge this and that's it, because it's very different for each company. And based on how we fund it, fund for growth. So, but do talk to us, because we can run scenarios. We can say, oh, you know, we can run how much for 200K, but I need 50 this month, and we'll discuss that. You know, yeah.
Great. Okay. Thank you for that, Gary. And I've shared your email address and everything with everyone there. So if they do have any questions and want to reach out to you, then they're able to there as well. But I really appreciate you taking the time to go over all of the insight and the services that Finance Fair offer, and going through that sort of journey that a business goes through, you know, and the challenges that they have. I'm sure that spoke to some of the challenges that all of our attendees are experiencing as they're growing their businesses. So I have no doubt that all of our attendees found that beneficial. So thank you so much, Gary, for taking some
My
time
pleasure.
on this lovely
Thanks very
Thursday
much.
morning to share all of your insight. We really appreciate it. Looking forward to having you on again in the future as well.
Yeah, great. I really enjoyed that, and thanks very much. You know, definitely do enjoy these sessions and just chatting through. So, you know, absolutely no problem. Thanks very much for inviting me along.
Yeah, thank you, Gary. Okay,
Thank you
well,
very much, Gary.
I hope everyone has a great day now, onwards and upwards with all of your businesses, and have a good day. Thanks so much.
Bye.
Bye bye now.